Imagine a company so powerful, so innovative, and so incredibly wealthy that it was named America's Most Innovative Company by Fortune magazine for 6 consecutive years. A company that sat at the very top of the corporate world, with a stock price that seemed destined to climb forever, and a headquarters that symbolized the future of global trade. At its peak, this titan was valued at over $70 billion. Its executives were treated like rock stars, its business model was hailed as the blueprint for the 21st century, and its employees believed they were part of a revolution that would change the world. But beneath the gleaming glass of its Houston skyscraper and the glowing reports from Wall Street analysts, there was a rot so deep and a deception so vast that it would eventually trigger the largest bankruptcy in American history at the time. This is not just a story of bad business or a market downturn. This is the story of a massive, systemic, and calculated lie. This is the rise and fall of Enron, the $70 billion corporate fraud that fooled the entire world. To understand how Enron became a juggernaut, we have to go back to 1985. The company was formed through the merger of Houston Natural Gas and Internorth, a pipeline company based in Omaha. At its inception, Enron was a relatively boring, traditional energy company. It owned pipelines, moved natural gas from point A to point B, and operated within a heavily regulated industry. The man at the helm was Kenneth, a soft-spoken son of a preacher with a PhD in economics. Lay was a massive proponent of deregulation. He believed that the government should step out of the way and let the markets decide the price of energy. As the energy markets began to deregulate in the late 80s and early 90s, Lay saw an opportunity to transform Enron from a simple utility provider into something far more ambitious. But the real transformation of Enron didn't begin until Kenneth Lay hired a brilliant, arrogant, and hyper-competitive consultant named Jeffrey Skilling. Skilling didn't care about pipes or pumps. He saw the world through the lens of pure finance. He proposed a revolutionary idea. Enron shouldn't just deliver gas, it should trade it. He wanted to create a gas bank where Enron would act as an intermediary, matching buyers and sellers and taking a cut of every transaction. This would allow Enron to hedge against price fluctuations and guarantee profits regardless of which way the market moved. Lay was captivated by the vision, and Skilling was brought on board to lead this new division. Skilling's arrival marked a fundamental shift in Enron's DNA. He pushed for the company to adopt an accounting method known as mark-to-market. In traditional accounting, you record the value of an asset based on what it cost you. In mark-to-market accounting, you record the value of an asset based on its current market value, or, more dangerously, its projected future value. This meant that the moment Enron signed a long-term contract, it could estimate all the profit that contract would generate over the next 20 years and book it as immediate revenue today. If those projections turned out to be wrong, Enron would simply adjust the numbers later. It was an accountant's dream and a realist's nightmare. It allowed Enron to report massive profits on paper for projects that hadn't even started or were actually losing money. The Securities and Exchange Commission, surprisingly, gave Enron permission to use this method in 1992, effectively handing the company a license to print imaginary money. As the 90s progressed, Enron's ambition grew boundless. They weren't just trading gas anymore, they were trading electricity, coal, paper, steel, and even weather futures. They were the pioneers of asset-light business. Skilling argued that owning physical assets like power plants and pipelines was old-fashioned and capital-intensive. It was better to sell the assets and just trade the commodities. This allowed Enron to keep its balance sheet looking lean while its trading volume exploded. By the turn of the millennium, Enron Online, their web-based trading platform, was processing billions of dollars in trades every single day. To the outside world, Enron was a high-tech miracle, a company that had successfully merged the old economy of energy with the new economy of the internet. But there was a massive problem. The more Enron traded, and the more it expanded into new ventures like high-speed broadband, the more money it was actually losing. The mark-to-market accounting was hiding the losses, but it couldn't hide the fact that the company was running out of actual cash. To keep the stock price rising, Enron needed to keep reporting record profits. To report record profits, they needed to hide their mounting debt. This is where the third key player in the Enron saga enters the frame, Andrew Fastow, the chief financial officer. Fastow was a master of financial engineering. He created a complex web of thousands of off-balance sheet entities, known as special purpose entities, or SPEs. These entities were given names like Chuco, LJM, and Raptor. On the surface, they appeared to be independent companies that Enron was doing business with. In reality, they were controlled by Fastow and used to hide Enron's toxic assets and massive debts. When an Enron project failed or lost value, they would sell that asset to one of these SPEs. This allowed Enron to scrub the loss from its books and replace it with a fresh infusion of cash, which was often just a loan guaranteed by Enron's own stock. It was a giant shell game. Fastow even used these entities to enrich himself, skimming tens of millions of dollars in management fees and kickbacks while the company's foundation crumbled. The culture inside Enron was just as toxic as its accounting. Jeffrey Skilling implemented a performance review system known as Rank and Yank. Every year, employees were graded on a scale of 1 to 5. Those in the bottom 15% were fired. This created a cutthroat environment where employees were encouraged to do whatever it took to hit their numbers, even if it meant sabotaging colleagues or engaging in unethical behavior. The pressure was immense. The mantra was innovate or die, and at Enron, innovation often meant finding new ways to manipulate the system. One of the most egregious examples of this manipulation occurred during the California energy crisis of 2000 and 2001. As the state struggled with a botched deregulation plan, Enron's traders saw an opportunity to squeeze the market for every cent. They used strategies with names like Fat Boy, Death Star, and Get Shorty to create artificial shortages. They would shut down power plants for maintenance during peak demand or ship electricity out of the state, only to sell it back at a massive markup. While Californians suffered through rolling blackouts and sky-high utility bills, Enron traders were recorded on phone lines laughing about the grandmas who were being overcharged. These tactics generated billions in profits for Enron, but they were built on the misery of millions. By the year 2000, Enron was at its absolute zenith. The stock price hit an all-time high of $90.75. Analysts were falling over themselves to recommend the stock, with some predicting it would reach $140. Kenneth and Jeffrey Skilling were the kings of Houston, but the cracks were starting to show. The dot-com bubble had burst, and Enron's massive investment in broadband was proving to be a disaster. The company had spent hundreds of millions of dollars laying fiber optic cables for a market that didn't yet exist. Under the mark-to-market rules, they had already booked billions in profits from these ventures. Now, they had to figure out how to keep the lie going. The beginning of the end came in early 2001. In February, a reporter for Fortune magazine named Bethany McLean published an article titled, "Is Enron Overpriced?" She had been looking at the company's financial statements and realized she couldn't understand how Enron actually made its money. The numbers didn't add up. When she asked Jeffrey Skilling for clarification, he became defensive and abrasive, famously calling an analyst an asshole during a public conference call when questioned about the company's lack of a balance sheet. The aura of invincibility was fading. In August 2001, the business world was shocked when Jeffrey Skilling suddenly resigned as CEO, citing personal reasons. He had only been in the top job for 6 months. Kenneth stepped back into the CEO role, assuring employees and investors that everything was fine and that the company's best days were ahead. But behind the scenes, a high-ranking executive named Sharon Watkins had seen enough. She sent an anonymous memo to Lay, warning him that Enron was about to implode in a wave of accounting scandals. She detailed the shady dealings with Fastow's SPEs and told Lay that the company's financial statements were a fraud. Lay ignored the warning and continued to publicly pump the stock, even as he and other executives were quietly selling off their own shares. The house of cards finally collapsed in October 2001. Enron reported a massive third-quarter loss of $618 million and announced a $1.2 billion reduction in shareholder equity. The SEC opened a formal investigation. As the truth about the off-balance sheet entities began to leak out, the stock price went into a free fall. Within weeks, it dropped from over $30 to less than $1. Credit rating agencies downgraded Enron's debt to junk status, triggering a clause that required the company to immediately repay billions of dollars it didn't have. On December 2, 2001, Enron filed for Chapter 11 bankruptcy. It was a seismic event that sent shockwaves through the global economy. Thousands of employees lost their jobs overnight. Even worse, many of them had their entire life savings and retirement funds invested in Enron stock, which was now worthless. Because the company had encouraged and sometimes forced employees to hold Enron stock in their 401ks, people who had worked for decades saw their futures vanish in an instant. Meanwhile, the top executives had walked away with hundreds of millions in bonuses and stock sales. The fallout didn't stop at Enron. The company's auditor, Arthur Andersen, one of the big 5 accounting firms in the world, was found to have been complicit in the fraud. They had not only signed off on the deceptive financial statements, but had also systematically shredded thousands of documents as the SEC investigation began. Arthur Andersen was convicted of obstruction of justice, a verdict that effectively ended the firm's 89-year history and put 85,000 people out of work globally. The scandal proved that even the gatekeepers of the financial system could be corrupted. The legal battles that followed were long and grueling. Andrew Fastow eventually cooperated with prosecutors, detailing the mechanics of the fraud in exchange for a lighter sentence. He served 6 years in prison. Kenneth and Jeffrey Skilling maintained their innocence, claiming they were unaware of the details of the accounting and that the company's collapse was caused by a run on the bank and a conspiracy of short sellers. The jury didn't buy it. In 2006, both were convicted of multiple counts of conspiracy and fraud. Kenneth died of a heart attack just months before he was to be sentenced, leaving his legacy forever tarnished. Jeffrey Skilling was sentenced to 24 years in prison, though his sentence was later reduced, and he was released in 2019. The Enron scandal changed the face of corporate America forever. In response to the fraud, Congress passed the Sarbanes-Oxley Act of 2002, which introduced strict new regulations for financial reporting and corporate governance. It made CEOs and CFOs personally responsible for the accuracy of their company's financial statements, with the threat of prison time for those who knowingly sign off on false data. It was intended to ensure that a disaster like Enron could never happen again. But the legacy of Enron is more than just a set of laws. It is a cautionary tale about the dangers of unchecked corporate greed, the folly of complex financial engineering, and the fragility of trust in the marketplace. It showed how easily a culture of arrogance can blind an entire organization to the reality of its own failure. Enron wasn't just a company that failed. It was a company that chose to lie rather than admit it was failing. It was a giant built on a foundation of air, sustained by the belief that they were the smartest guys in the room. Today, the name Enron remains synonymous with corporate fraud. It serves as a reminder to investors that if a business model seems too complex to understand, it probably is. It reminds us that record-breaking profits and soaring stock prices can sometimes be a mask for deep-seated problems. And most importantly, it reminds us of the human cost of such deception, the thousands of families whose lives were upended by the choices of a few men who thought they were above the rules. As we look at the modern landscape of tech giants and financial behemoths, the lessons of Enron are as relevant as ever. The pressure to innovate, the drive for quarterly growth, and the temptation to use creative accounting are still very much present. History has a way of repeating itself when the lessons of the past are forgotten. The rise and fall of Enron was a $70 billion lesson that the world paid for in jobs, pensions, and lost faith. It was a collapse that proved that no matter how high a company rises, it can never outrun the truth forever. The story of Enron is a dark chapter in economic history, but it is also a necessary one. It exposed the vulnerabilities in our financial systems and forced a reckoning with the ethics of capitalism. As we move forward, the ghost of Enron continues to haunt the boardrooms of the world, a silent warning that transparency, integrity, and accountability are not just buzzwords, they are the very pillars upon which a stable economy must stand. Without them, even the most innovative and powerful empire can crumble into dust, leaving nothing behind but a trail of broken promises and a $70 billion hole in the history of the American dream. The executives at Enron believed they had discovered a new way to do business, a way that transcended the old rules of economics. They thought they could create value out of thin air, through sheer force of will and mathematical wizardry. But they forgot one fundamental truth: wealth must be built on something real. You can't trade your way to prosperity if there is no underlying value. You can't hide debt forever by moving it from one pocket to another. And you certainly can't fool everyone all the time. In the end, Enron's greatest innovation wasn't a trading platform or a new energy derivative. Its greatest innovation was the scale of its deception. It managed to deceive the most sophisticated investors, the most prestigious banks, and the most respected regulators in the world. It was a masterclass in corporate theater, where the stage was the global market, and the actors were some of the most talented minds in business. But when the curtain finally fell, the audience was left with nothing but an empty stage and a very expensive bill. The fall of Enron wasn't just the end of a company. It was the end of an era of blind faith in corporate leadership. It taught us to ask the hard questions, to look past the glossy brochures and the charismatic CEOs, and to demand to see the actual numbers. It taught us that innovation is no substitute for integrity. As we look back on the wreckage of that $70 billion fraud, we are reminded that the most important asset any company can have isn't its stock price or its intellectual property. It's the trust of its employees, its shareholders, and the public. Once that trust is gone, no amount of financial engineering can ever bring it back. The Enron saga remains the ultimate benchmark for corporate malfeasance. Every time a new scandal breaks, or a high-flying startup is revealed to be a sham, we look back to Houston in 2001. We look back at the men who thought they were too smart to fail, and the system that was too blinded by profit to see the warning signs. The rise and fall of Enron is a permanent scar on the face of the global economy, a reminder that the pursuit of profit, when divorced from ethics, leads only to ruin. It is a story that continues to be told, not just as a piece of history, but as a vital warning for the future. In the world of finance, the numbers don't lie, even if the people behind them do. And eventually, the numbers always tell the final story.
If you liked this video, please hit the like and subscribe button for more.